Fortune magazine named Enron America's most innovative company 6 years in a row. Turns out they were right. Nobody had ever innovated a $65 billion fraud before. 1990s, Enron is a gas pipeline company in Houston, Texas. Boring stuff. Then they discover a legal trick called mark-to-market accounting. You sign a 20-year energy deal. You estimate the total profit over those 20 years. Then you book all of it, every dollar, as revenue today. Day one. No cash has arrived. The deal hasn't played out, but on paper you just made billions. Wall Street loved it. By August 2000, Enron stock hit $90.75. Seventh largest corporation in America, built on money that didn't exist yet. But fake revenue creates a real problem. Eventually, actual cash has to show up. It didn't, so Enron built a machine to hide the gap. Over 3,000 shell companies called special purpose entities. Some were named after Star Wars characters. Jedi, Chuko, this is not a joke. Enron would take billions in debt and transfer it to these shells. The debt disappeared from Enron's books. Investors saw a healthy company. Running this machine, Enron's own CFO, Andrew Fastow. Fastow personally made $45 million from both sides of the deal. Employed by Enron and employed by the companies defrauding Enron, this was in the SEC filings. Nobody looked. The betrayal gets worse. Enron's top executives, Skilling, Lay, Fastow, knew the company was hollow. They sold over $1.1 billion in personal stock while the ship was sinking. At the same time, they sent company-wide emails to all 20,000 employees. The message, buy more Enron stock for your retirement. 20,000 employees listened. They loaded their retirement plans with Enron shares. Then Enron locked them out. A blackout period. Employees couldn't sell their stock, while executives kept dumping their shares, workers' life savings, frozen, executives cashing out. October 2001, the House of Cards falls. Enron reports a $618 million loss. The SEC opens an investigation. $90, 50, 20, 10. By December, 26 cents. A 99.7% loss. $65 billion in shareholder value gone. 20,000 employees lost their jobs. Most lost their retirement savings too. The stock they were told to buy, that they were locked out of selling. Worth nothing. Arthur Andersen, one of the big 5 accounting firms, founded 1913. Their job was to audit Enron's books, verify the numbers were real. They signed off every year. When the SEC came knocking, Andersen panicked. They shredded 1 ton of documents, deleted 30,000 emails. An 89-year-old firm, convicted of obstruction of justice, gone. CEO Jeffrey Skilling, 24 years in prison. CFO Andrew Fastow, 10 years. Chairman Kenneth Lay, convicted on 10 counts of fraud, died before sentencing. Congress passed the Sarbanes-Oxley Act. Stricter audits. CEOs personally liable for financial statements. Laws changed. People went to prison, but one thing still doesn't add up. Fortune magazine watched Enron for 6 years and gave them an award. The same year, the company collapsed. Wall Street analysts recommended the stock right up until the end. The SEC reviewed the filings that disclosed Fastow's conflict. The smartest people in finance looked directly at this fraud for 6 years. Did they miss it, or did they choose not to look? If you like stories like these, please like and subscribe.